This is where, in my opinion, the real wealth starts to build. You really start to see the snowball grow and grow. And in my opinion, it's when you start seeing your stock double. Whenever the stock is up 100%, now, whenever the stock goes up 1%, based off your real cost basis, you go up 2%. You're really going up 2% based off your real cost basis. And especially when you're up over triple, like look at Powell Industries right here. This is one I own. We bought this one 10 months ago. We're up over triple on our shares now. Now, based off my cost basis, whenever the stock moves 1%, I actually go up 3%, which is really cool. And I know that kind of sounds obvious. And I also wanted to give you a quick portfolio update of our buy and never sell portfolio. So yeah, if you guys don't know, a thing I do on my YouTube channel is once I buy a stock in this portfolio, I'm never allowed to sell it for the rest of my life. You know, it's worked out good for some like DocuSign, Powell Industries, but I'm not here to sugarcoat things. Like, look at this, you could lose a lot of money. I recommend a DCA into a stock, dollar cost average, but it doesn't always save you. The stock could still go down no matter what. So there's always risk. This isn't financial advice. And let me show you a quick picture from, this was about 8-9 months ago. This was my old stock portfolio, or this was my portfolio 8 months ago. And remember, I can never sell a stock once I buy it. Here, look at Powell Industries. We were up over double. Most people would maybe sell that or maybe trim a little bit, you know, because you're already up double on it. But I haven't sold any shares. We're now up over triple, as you just saw. Look at DocuSign. They were only up 40%. CubeSmart was just 3%. Look at Nike. We're now down a bunch on Nike, but Nike was actually green at the time back here. So this was my entire portfolio just 8 months ago. So I really am never selling a stock once I buy it in here. So if you come back to my channel in a couple years or something, hit the subscribe button. I'd really appreciate it. If you're wondering why is one stock blurred out there, I'm doing a total stock portfolio update in a later video, and I wanted to share my next video. I want to show you what I bought in there. So I'm not going to reveal what I bought just yet in that account. But also, I want to show you my Robinhood account. If you notice, we're now over $17,000, and that's mainly from me depositing money into the account. And I'm not going to scroll all the way to the bottom here because I just bought a brand new stock in this portfolio, and I don't want to reveal it yet. But I'll show you the stocks I've already kind of shown you before. Like here are my stocks right now that I own. You know, we got Salesforce, we got Google, McDonald's, Meta, Constellation Energy, and Realty Income. You know, these are all very high quality dividend stocks. Actually, every stock in here pays a dividend, and every stock in here is in the S&P 500, which is pretty cool. But I'll really quickly talk about Salesforce. Man, they had some great earnings. They grew their free cash flow 30% year over year. They're buying back shares. They now pay a dividend. So this is a fantastic software stock. They just hit an all-time high though, so it's kind of hard to buy into them right now, but I'm a super happy Salesforce shareholder. Oh, and this is our main taxable account. We also have a Roth IRA with Robinhood. You know, it's a pretty trash Roth IRA. We only got 2 stocks in here. We have some YOU stock, which is actually a pretty cool stock. I'll look into the financials at the very end of this video. If you're curious about YOU stock, they actually are a stock buyback machine, and they pay a growing dividend. Stay tuned to the end of the video for that. But yeah, the main point I wanted to make in today's video was don't sell your winners. You know, don't sell a stock just because it's up 100%. Like, look at this stock right here, Powell Industries. Even if I didn't have the rule where I'm never allowed to sell a stock in here, I wouldn't sell this one because look at the PE ratio. Powell Industries, even though they're at an all-time high and they're up triple, the PE ratio is a 23. They're also completely debt-free with $350 million of cash. So 10% of the entire market cap right now is just cash, and they have zero debt, and they're trading at 23 times earnings. So even if I was a trader, you know, I don't know if I'd be exactly selling out of this company, even though we're up triple on them. The valuation still makes sense. They're still in pure growth mode. If we head over there and look at this company's net income, it's up 74% year over year. So that's kind of why I'm not selling this stock. And usually, like, look at this. This company's growing their net income 74% year over year. That's why the stock price is going up so much. So usually when a company is growing their profits, growing their financials, the stock price will usually follow that. Another position we've been dollar cost averaging into is Disney. I'm actually thinking about buying some more of this one, even though we're up quite a bit on them. I actually really like their financials. They also just rose their dividend to $1 annually, or 50 cents per share, which was a 33% raise. And if we quickly just go and look at Disney's FCF, which is free cash flow, it was up 17% year over year to $4 billion. And they rose their guidance as well. S&P Global just gave an update on Disney that they're expected to deleverage in the year 2025. So the financial outlook on Disney's looking good. That's kind of why I have a position in them. They're also part of my buy and never sell portfolio. So yeah, again, if you want, hit the like button. I'd appreciate that. And if you hit the subscribe button, come back to my channel in a year, 2 years. I will still own all these exact same stocks. And also like this stock down here, we're down over $1,000 on this one. If I was a trader, I wouldn't actually take the L on this one. I would not sell out of this stock for a loss right here. First off, the PE ratio is a 10, but that's not why I wouldn't sell this one. Actually, I'm going to go over here to my Webull account to really show you the financials on this one. So here's why I wouldn't sell this one even though they're at an all-time low. Look at the market cap. Just remember that. This whole company is worth $425 million. So remember that market cap. The whole company is worth $425 million. Look at the cash they have on hand. $383 million of cash. And they're also debt free. I guess I forgot to mention that. They have zero debt, so they don't owe anyone any money. That's why it says zero here. Perion Network's completely debt free. And since they have a bunch of cash, they're also making interest on their cash. Their cash is going down a little bit. That's actually because they're doing stock buybacks and investing in the company. But they made $5 million of pure interest in the most recent quarter. And look at this. In the two most recent quarters, they are buying back some stock. And you're like, it's only $13 million. Well, remember, the whole market cap is $425 million. And they're debt free with a bunch of cash. So they can buy back 50% of the whole company right now if they wanted to. But that's not the smart thing for them to do. I'm glad they're investing in the future. But why did the stock fall so much? This company actually lost a contract with Microsoft, which is, the biggest company in the entire world. And look what that did to their net income. So the growth is gone from this company. Look at this. The net income just plummeted. It even went negative last quarter. So the growth rate is gone for this company, but it's not also bad. So they lost their search advertising partner with Bing. I want to show you, I'll be really quick with this. This is not financial advice. I'd be very careful with Perion Network, but they are actually still a growth company, and I'll show you why. So here's the main slide I wanted to show you from their investor presentation. This is their main growth engines. They do advertising. DOOH, digital out-of-home advertising. And look at this. This is kind of the growth we're seeing. 63% growth year. Again, it's a very small, but the whole company is worth $400 million. So this went from $11 million to $19 million. Their retail media went from, Q3 2022 to $6 million, doubled to 13, and now it's up to 21 million. So then if they can keep up this growth rate, they're actually, this is why I think they're to an extent a growth company. And look at their CTV success. We can see this is, again, $9 million, but it is growing 20% growth year over year. And this is what I was talking about with the lost contract with Microsoft. Look at their search advertising revenue. It went from 86 million to 20 million. So this absolutely tanked to 78% year over year decrease. So that's why they're actually now focusing more and more on their other forms of advertising. Their whether it's the CTV, the retail media, and the digital out-of-home advertising. So they're focusing on these segments because their search advertising revenue is plummeting. So they lost their growth there, but they could be growing in some other segments. So not all hope is lost. But finally, guys, I want to show you why here in my Roth IRA. I picked up 2 shares of YOU. Again, it's 2 shares, it's nothing, but I plan to add more into this position. I want to show you why I did this. So first off, they're a brand new company. They just went public about 3 years ago. And look at the market cap. They're less than a $4 billion company. So they're a super small company. But let me show you why I'm so impressed with this company. Look at the growth rate here. I always look for growing companies, that used to lose money every quarter. Well, now here they are in the four most recent quarters, made over $100 million of net income, well over that. It is not just their net income, it's just their sales. Their sales are growing 23% year over year. So fantastic growth on the company. And let me show you a little more about their financials. This is what I really look for in a company. So look at the cash on hand in the most recent quarter. They actually have $544 million of cash right now. It looks a little choppy. I'm not sure what happened the 2 most previous quarters, but anyway, they have $544 million of cash. Are they diluting you? So you do got to be careful. They are diluting the shareholder. You've been diluted 4.7% year over year, so do be aware of that. And remember, this company also pays a dividend. So just remember the net income in the most recent quarter. They made $38 million of net income in the most recent quarter. And let's see how much their dividend cost. So check this out. Their dividend only cost $9 million. Well, actually, hold on a second. I don't know why it looks this weird. It's like 30 million some quarter and then 9 million. So actually it might cost a little more than that. I'm not exactly too sure, but you would consider diluted normalized EPS. So they're cranking out EPS. Well, let's look at it this way. Actually, this will be the better way to look at it. They made 24 cents of diluted EPS and they made 12.5 cents, or their dividend cost 12.5 cents Okay, so I just realized something. Look at this. This company actually pays special dividends. So this is starting to make a lot more sense now. I am sorry. I might as well just restart this whole recording. I didn't even know this. This company actually pays out special dividends. So that's actually why the cost of the dividend fluctuates so much. Is that this company sometimes pays out special dividends, which is actually very cool. I didn't know that. So it looks like their real normal dividend only costs $9 million, but whenever they pay out a special dividend, it cost more. So now that we know that context, that's great to know. They're also, look at this. This is the interest that they're making on their cash. They made $7 million in the most recent quarter of pure interest, which almost covers the cost of the dividend, which is actually pretty cool. Oh, and guys, I just don't believe this. This is why their cash has gone down so much. Look at the stock buybacks that they're doing. So they're doing stock buybacks, but you're still being diluted. So that means they do have some stock-based comp, but it's great to see that they're buying back shares, doing special dividends. Well, hold on a minute, guys. Look at this. So they spent 70 million on stock buybacks. If we go to the total common shares outstanding, it says the shares are down 8% year over year. So, but that's their total common shares outstanding. It's actually on the left here. Look at that. It says you now own 8% more of the company. But if we go to their diluted weighted average shares, which includes, employee benefits and stock-based comp or future contracts, or stock options is what I'm trying to say. It says you've been diluted 5% year over year. So maybe someone in the comments can let me know about that. I'm definitely not an expert. So if you know any more information about that, let me know in the comments. But yeah, that was pretty much the video. I'm really great to be a DocuSign shareholder and a Salesforce shareholder. Those were two companies with some fantastic earnings. But anyway, thank you all for watching. Don't forget to drop a like on the video if you found some value in this. I'd appreciate that. And I hope you guys have a great rest of your day.